Another topic reshaping the industry these days is alternative capital. We spoke with Bryon Ehrhart about this trend at the S&P Insurance Conference. He is CEO of the Americas at Aon Benfield and had this to say about the issues affecting alternative capital now and into the future.
Well, the growth in the alternative market in the last few years has been driven by really clients that have been seeking to diversify their sources of catastrophe risk capital, and that's been met with investors that are looking to diversify their investment returns. Well, to disrupt the flows, which we're not really anticipating, our projection for the firms that would go from $64 billion of alternative capital deployed in the business to about $150 billion by the end of 2018. So we're not seeing much that's going to disrupt that flow. There is, of course, discussion about what would an interest rate shift that's material mean, and that's maybe 100 to 300 basis points. Well, if it's in the 50 to 100 camp, it actually means that mark-to-market yields on the rest of pension funds and high net worth individual bond portfolios are going to be down. So that actually might have the effect of bringing more capital into this industry rather than the opposite effect, which many would anticipate. Certainly, large events are a little bit of an X factor in as much as every event, whether you're a traditional reinsurer or an alternative capital provider in the industry, you're going to learn something from those events. The modelers themselves learn from these events. We learn as a broker from these events. Our clients learn from the events. And we have traditionally had a significant role in aligning capital to the next opportunity, and we anticipate the alternative capital will be just as interested in the next opportunity after an event as traditional reinsurers would be. In fact, they've been very complementary in providing diversified sources of catastrophe capital and underwriting capital for our clients. The flow of alternative capital has affected the reinsurers business model first. It will now get to the insurer business model. And it's meant that there's a value proposition in lower cost underwriting capital. And so reinsurers have, in the last 24 to 36 months, essentially called an end to the beginning, where the beginning was kind of dabbling in the alternative capital, making sure that it can be there to support their value proposition to their customers, to now they're seeing it as really a mandatory incorporation element. And they're now beyond essentially the planning phase and moved into the execution phase, where they now have sponsored catastrophe bonds to actually lower the cost of underwriting capital for the tail, sponsored sidecars to take proportional risk in their portfolios, and then also beginning to manage assets for investors that seek the diversification of their yields into this asset class. Risk modeling plays a very important role in bringing the alternative capital in. All of the alternative capital investors seek some relative ranking of the risk that they're taking. Of course, they want to be paid a fair price for the risk that they're taking. Sometimes they get a chance to look at ratings that are provided on the bonds, and they can compare that to similarly rated credit. So the models help get the ratings. The models inform the investors of the risks. They then at least have a relative model to compare deal to deal and sector to sector. So it's been very important. The models have been through changes, just as I mentioned in the answer to a prior question, where after every event, we all learn, and the models adjust. The models kind of bring us to a new relative basis for transactions going forward. Alternative capital has, I think, more appetite than the current demand is reflecting, and that's going to cause them to go into new sectors. And those new sectors often are talked about as being casualty, for example, or other short tail lines other than casualty. I guess our firm has the view that it's more likely to go to commercial insurance first. It's a path of less resistance than solving some of the hard problems that are involved in doing a casualty-based securitization. We've certainly tried many times to get casualty into the securitization market, and really when you need multi-year collateral that needs to be served with some yield over the duration of the risk period, and casualty can have quite long tail, it's really hard to service it. But when you think about commercial insurance and places that are sublimited like flood, quake, business interruption, or even contingent business interruption, I think there are plenty of opportunities where alternative capital can be complementary capital to Aon's clients. In a platform like Aon Risk, where it includes both the reinsurance business and the original retail insurance business, there's no question that our clients in both divisions benefit from the experience we first had as reinsurance brokers, helping clients diversify their sources of underwriting capital, particularly for catastrophe risk. And that skill is really easily translated into the retail sector, where large corporations with billions and billions of dollars worth of assets at risk, much like small insurance companies, actually seek our advice to manage capital around their risks.
For more of the S&P Insurance Conference, visit the RIN TV On Demand Library.